Tubing inside, not outside.
Okay, so as I was saying,
Air pressure, but not air. Yeah, I was thinking about exposures, but that would work.
so what I did for this review is I laid out the chapters and the specific topic that I'd like you to kind of narrow in on. Brush chapter is really covered, so pay special attention to that. So chapter 3, it's got the basic definition of M1. Continue to talk about the whole semester. M1, checking in, careful, currency, right? So currency and checkable deposits, checking account deposits. And then M2 was savings. Traveler's checks was actually in there, but in M1 actually. Short-term deposits, or time deposits. And then you're missing the most important thing in M2, M1. So M1's in there. So that's the one thing that it keeps adding on. It doesn't eliminate the other. Okay, so we got those basic definitions of money. Then chapter 4. We had 4 types of credit market instruments. There's a section in this chapter. This one I put the page number at. Page 69 is this section. And the 4 types were a simple loan, the fixed payment loans. So this would be like your mortgage, you get a 30-year mortgage, and so we got mortgage-backed securities. Number 3 was a coupon bond. All of the T-bills and other corporate bonds was a coupon bond. And then the last one was the discount bond, where we kind of pay the interest up front, and there's just a single payment at the end. I don't know, I was thinking about that.
Yeah, I'm thinking it's not going to help ours out, right?
That's a good point. It's battery backup, isn't it? Good thinking, yeah. Yeah, that's a battery. You'll have to tolerate it.
Might be an issue.
That's all right. I don't think there's some sort of little warning button. Maybe there's a silence button or something, but I think we'll have to just tolerate it. All right, so with these, embodied in all of this stuff is the time value of money. So kind of the key thing with all of this is the time value of money, which is the present value of something is equal to the future value divided by 1 plus I raised to the n power, the number of years that it's out. And note, if multiple years, each year must be treated independently. And that gave us the little bit more complex way of the sum of I equal 1 to, and let's not even do it that way. Let's just show you the basic. Something coming 1 year away, we get it raised to the 1 power. 2 years away, we do a separate equation just like that. The second power plus a third year gets its own independent treatment. So if it's 4 years, 5 years, 10 years. So that's the one thing that people tend to mix up a bit.
Just to be clear, Russ, that means future value 1, future value 2, future value 3, and not future value. You're not raising that.
It's the payment that came in year 1, the payment that came in year 2,
Yeah,
the payment that came in year 3.
Make sure.
Oh, I'm not cubing it. Yeah,
Yeah.
right. Yes. All right. I don't know about you, but I am already boiling. Let's see. Where's our muscle man? Yeah, I think you're right. You know, they came and did those windows.
Well, I mean, if we really does.
Yeah, we could try the door.
It's just not a very reverse.
Yep, you're right. It is sealed tight. Did you try these two? Be in my undershirt here in a second. Yep. I think when they redid all the windows, they sealed them up. Because I think just last year you were able to do that.
I can't see mine.
Woo!
Let me open the door.
Yeah. Oh, it is a little cooler out in the hallway. Okay, I'll live. I'll live if you guys can. All right. So the other key way to solving this that I recommend is to put it in that timeline. So we've got the initial investment. 1, 2, 3, 4. This is just my little note. Use a timeline. And that makes it a little bit easier. And then you're just mapping up the payments in each year and thinking about how that discounts back. Okay, any other questions or comments on that one? Fisher formula was also covered in this chapter, which we talked about throughout the whole course at different times anyway. The Fisher formula, the interest rate, the nominal interest rate is equal to the real rate plus the expected inflation rate. We did talk about it ex post and ex ante. If it's talking about a previous interest rate, we can observe, we actually know what inflation was, we can plug it in, versus what goes on today is decision makers decide what they think inflation is going to be and make their decisions on what the bank's going to charge for their financial instrument, right? So that was the Fisher formula. So just rewriting that by bringing the R over this side and the interest rate over there. You can also think about what lenders really care about. Lenders and borrowers is what the economist would argue is the real rate of return, whether you're on the borrowing side or the lending side. Okay, chapter 5. Chapter 5 used supply and demand. I think this was our first time we used it up to this point, kind of laying the foundation for the bond market with how these financial instruments are calculated. And now we move into predicting what type of movement there'll be. So we had the quantity of bonds, the volume of bonds, and the price of bonds. Bond demand, bond supply. And we had the equilibrium amount of bonds and the price of bonds. We talked about deficits and inflation and things that move these curves around to alter the price of bonds. This brought up the important relationship between interest in the price of bonds, which was what? Inverse, yeah. So negative relationship as the price of bonds go up because there's an increase in demand for bonds. Maybe the government starts borrowing for a deficit, let's say. They start to drive up the price of bonds, right? So price of bonds goes up, or I'm sorry, the supply of bonds if they're selling bonds. I knew that was heading the wrong direction for me mentally. So the supply of bonds increases, driving prices down, interest rates climb. In that chapter, then, they also introduced the kissing cousin, which is the money market. And this is the quantity of money, where we're measuring interest rates, and we introduce the Federal Reserve with a vertical money supply curve. So the Federal Reserve, through its powers of controlling the money supply or altering it, can increase or decrease the supply of money and therefore influence interest rates, which then later on, of course, we talked a little bit, put that in more detail. So we've got the three tools. We've got the three tools that shift the supply of money. So we've got Fed tools, which I'll talk about here in a little bit when we get to the later chapters. All right. So kind of focus in on your studies about what is the bond market, what does it do, do I have this at least memorized, memorize all these home bases. That might be a good short answer problem, or possibly with a multiple choice or something. So have those elements of chapter 5 down. Then we jump to chapter 16. We actually did chapter 10 and 12 where we talked about individual bank behavior, which was important in its own right, but I decided I didn't want to throw the whole kitchen sink at you again. I just wanted to focus in on some of these meatier aspects of money and banking. So figure 1 is the bread and butter. Figure 1, page 374, which I also gave you a handout on, so hopefully you guys have it. I don't know if I've got some extras. They are also in the PowerPoint. That I probably got a few. It's the figure that yep, here it is. It was the figure that just gives you a nice summary of the Fed. And I think now that you go back and review this figure, it'll make a lot more sense to you with all the stuff that we talked about. So it's got the Board of Governors, the 7-member Board of Governors. Chair Janet Yellen is the chair of that board. Its relationship with the 12 Federal Reserve banks scattered across the country, the Federal Open Market Committee, and then the open market operations, reserve requirements, and discount rates as the policy tools at their disposal. So go back and review that. Gives you the nice summary of details. And even on the handout, it says 7 members, including the chairman appointed by the president. So it gives some of those details that we also talked about in class. So I'll write a few of those high points down. So Board of Governors, the 12 Fed banks. No, you do not have to memorize the 12 Fed banks, but the fact that there's 12 you probably would need to know. Okay, 12 Federal Reserve banks, but some general things there. The Federal Open Market Committee, their role with open market operations. And then the three tools of required reserves, the discount rate, and open market operations. All right, so related to that, chapter 17 got into some of the mechanics of how the Fed's action the monetary base. So chapter 17 rolled into the monetary base, which is really the key monetary target that the Fed looks at. So the monetary base, reserves plus currency in the system. And the big question mark that economists debate about is the money multiplier. Can you see that? And we went through some exercises of some of these elements in it. So we got the relationship with currency drain and the required reserves plus the amount of reserves that the banks want to hold. So during the financial crisis, we talked about how our excess reserves, the amount of reserves that banks wanted to hold, changed. All right, so that's the focus on chapter 17. Chapter 18 gave us another market, our reserves market, which had our weird curves to it. So kind of know what the funky curves are all about. So this was reserve supply, reserve demand. These were the quantity of reserves. So this stuff's kind of related to each other, right? We've got the quantity of money, we got the quantity of reserves. The reserves are more specific to banks and the banking industry of how much reserves they have on hand, required reserves, and then reserves that they haven't loaned out yet, those excess reserves. So the interaction of those two things gives us the federal funds rate, the interest rate that banks charge to each other for short-term borrowing, very short-term borrowing usually. From the lower bound and the upper bound, the lower bound was newly established by the Federal Reserve, the interest on reserves, which, by the way, I still don't know if I'm onto something. I never got an answer. So I happen to be on whether, my question was whether they get paid interest on their currency. And so the Federal Reserve person I was talking to, she never got back to me. I asked the Federal Reserve in one of their little chat boxes on the big major site. I emailed that. They never got back to me, so now I think I'm onto something. They're trying to keep quiet to shut me up. So if I'm gone next semester, because I've uncovered maybe something going on that they don't want out to people. Head of a bank manager, where I was opening an account, and I said, do you get, she just said, they watch the amount of currency in the vaults pretty carefully, and they get kind of penalized if they're holding too much currency. This is from their company policy, not penalized from the Federal Reserve, but from their company. And I said, do you know if you get interest on your currency? And she thought no. So I got one no from a person who actually works bank. So I don't know what the deal is with that.
Oh, you
Is
got
it your
one
time
to
already? Oh yeah.
No, I thought you were going to be in the chapel. So.
Well, I was, but they don't have any windows there, so.
When you came over here.
Yeah, I came back. Needed a little light to hold the class, so. So, anyway, I'll get back to you guys if I ever get that answer, because I'm kind of curious now. So that is the interest on reserves. Maybe it's just on the reserves at the bank. Maybe it's currency in the vault. And then finally, this upper bound is the discount rate. So that is our policy tool that we learned from principles class. It's one of our basic ones. So really, this could be modified now to saying that they've got this lower bound as well, which for the most part doesn't come into play, I think, unless we're into financial crisis time frame. All right, so this is the quantity here of non-borrowed reserves. And then we went over some various cases with that. Chapter 22. We got into Uncle Milty here with the equation of exchange. Money times the number of times it gets spent in the economy over a year, in theory, should equal the nominal value of goods that were purchased and sold. This gave us this extra little math deal where the multiplication of two variables, if we look at their percentage changes, looks like this. So this is the rate of change of the money supply, if it's growing by 3% or 4% or 6%. This is velocity, whether it's changing. We assume that it doesn't for the most part, that it's pretty stable in the long run. This is inflation, the percentage change in the price level. This is real economic growth, because that's real GDP. And so our math tells us here that if we swing this over to the other side, we can look at the relationship of inflation in the long run. So the percentage change in the price level, inflation, is going to be equal to the percentage change in the money supply minus real changes in the economy, economic growth. So Friedman's theory here would be if we increase the money supply by 5% and there's 2% real economic growth, that should lead to 3% inflation. And Friedman's quote that he gave, I think I'll just squeeze this in here. So Friedman's quote was, inflation is always and everywhere, always and everywhere, a monetary phenomenon. That was the gist of his thesis. And even he would say, in the long run, which then brings us to our breakdown of the different schools of thought, which the aggregate demand, aggregate supply curves help us with. So for the monetarist camp, which is Friedman. So for monetarist like Friedman, their conclusion is if ultimately changes in the money, we believe that markets clear fairly fast. They don't buy into the Keynesian sticky wages stuff, that there's all long delays. So Keynes said in the long run we're all dead. Friedman says, that's much crap. I think that markets adjust fairly quickly. I think there's arguments to be made that as we move into the 21st century, the information flow allows prices to adjust more quickly too. So I think there's a good technology argument there that even Keynes would probably buy into. Part of the stickiness that was happening maybe in the Great Depression and at other times in our history was due to asymmetric information. You know, some parties knowing information better than others. And with the internet and other means that we have now today, the globalization of business, etc., I think there's a lot less stickiness now than what may have been true before. So that's the monetarist perspective, is that market prices adjust fairly quickly and efficiently. And therefore, monetary and fiscal policy, I'll throw fiscal in there, but mostly regarding monetary policy is what he was doing, but they would fall into this camp. Fiscal policy is even worse. That's where we get into the rifleman, a poor rifleman shooting through a dense fog at an erratically moving target with a poor gun and slow-moving bullets. That's the fiscal thing that we talked about last time. So both of these would be true for the monetarist, but especially monetary policy, which has always been argued to be the quicker, more accurate gun. We can do it faster, which is all true. They can implement those open market operations faster. Market prices adjust fairly quickly and efficiently, and therefore monetary and fiscal policy becomes inflationary. So don't do them. That may be a little strong. Don't do them to stabilize. Don't do them to government putting good laws on the books and maintaining highway systems and some other things. But as far as altering interest rates, quantitative easing, some of the actions through in chapter, the monetarist, which that always kind of was interesting when you first learned it, like monetarist. Oh, if you're a monetarist, then that means you must believe in monetary policy. Like, we should do monetary policy. Let's get all the nuts and bolts and details of how we can implement monetary policy. But it's actually just the opposite conclusion. The monetarist believes that we should have kind of a fixed monetary policy. Grow the money supply by something that's known to everybody and stable. Okay, any questions or comments on that? The monetarist camp would probably be similar to the Austrian camp. There's some similarities there anyway of the two. Depending on who you talk to, they might be more extreme of going back to the gold standard, where I don't think Friedman would necessarily say we for sure should go back to a gold standard, but there might be other ways that we can do it. All right. So, chapter I'm just going to talk about chapter 23 and 24 together because they really are just extensions of each other. Chapter 23 introduces the aggregate demand, aggregate supply, and all of its detail, and then reserves chapter 24 to how does that work specifically with monetary policy and some of the policy targeting. Know your home base. We drew it quite a few times. Ooh, we might have power, huh? Air conditioning really fast. So. Okay. So, a couple things to point out. In chapter 23, we just think about the inflation rate. In chapter 24, we started thinking about it being a target with the more of the Federal Reserve policy or central bank's policy if they are doing inflation targeting as a policy. So we kind of introduced a pi t here rather than a pi. So the current state of the economy is always given by the intersection of the short run aggregate supply and aggregate demand. So when you look at a graph, that is the current state of the economy. So we could do something like this to start you off with and say, suppose the economy looks like this. Well, currently the economy is here. And then where's it going? Aggregate demand and long run aggregate supply, right? So it's heading here through price adjustment. So through resource price adjustment and other prices, once prices adjust in the long run, we're heading back here if we take a hands-off approach. So that kind of helps you solve the problems, is to think about your eyeball going to the intersection of aggregate demand and long run aggregate supply. With a hands-off approach, that's where the economy is going to head to. So we went through a number of scenarios starting off with a long run equilibrium, shifts of supply, shifts of aggregate supply, aggregate demand, all the policy changes that could be done. You can, just as a kind of a hit list here for you, we looked at aggregate demand shocks in both 23 and 24. All these are is really the shifts of the curves. Temporary supply shocks, which is AS only the short run aggregate supply shifting. Permanent supply shocks, which is both long run aggregate supply and aggregate supply move together, and we talk about how those shifts look. So those are really the three things. Or as a kind of a separate thing is where we talked about inflation target policy versus output stabilization policy. And another thing we looked at was the demand pull and cost push. And how that concept is kind of related to the type of policy that the Fed is pursuing could lead to demand pull or cost push inflation. All right, almost done. Last thing really is just those distinctions we made with Austrian and Keynes, and I kind of talked about it here with the monetarists. That's right in the same vein, but we watched some videos. We got the Hayek video, that sort of thing, as kind of helpers. Keynesian versus Hayek, or I'm sorry, Austrian, I guess is what the handout was. We have the business cycle is the thing I'd like you to kind of review a little closer. So on that handout, that was Austrian, Keynesian versus Austrian. That videos were really about the business cycle. How does the business cycle go? So you might want to use the video if you want. I'm not asking specific questions exactly about the video to make sure you watched it, even though we watched it in class. And but they are available on YouTube, and those videos really highlight how does the business cycle start. Why do we have business cycles? You know, should we take the activist policy or the non-activist policy? Okay, that's it. Call it a day there. Get out of this hot box.